In New York City, I'm Julie Hyman. That's Josh Lipton. This is Yahoo Finance Live. Get ready for a wild ride this afternoon. We're counting down to 3 major earnings reports after the close. Apple, Amazon, and Meta all on deck. We've got all the key numbers you need to watch for, plus the breaking news and expert analysis after the market closes.
The broader market clawing back losses from yesterday's Fed-fueled sell-off. Consumer stocks leading the way here on Wall Street, and we're also looking at big moves in the bond market, taking a deeper dive into the market action and what moves you should consider for your portfolio.
Plus, Royal Caribbean shares trading on Yahoo Finance. The stock, though, under pressure after the company reported mixed earnings, even though the outlook was strong. Hear from the company's chief financial officer later this hour. Let's get you up to speed on the market action here as we await those big tech earnings here. We do have all 3 major averages in the green today, really as folks are still sort of digesting what we heard from the Federal Reserve's Jay Powell yesterday, as well as the earnings that continue to come out. I mean, even as there are sort of big macro narratives here, there are also a lot of micro stories and a lot of individual movers that we're watching. The Dow right now up 315 points or so, about 0.8%. The S&P gaining 1.1%. And the Nasdaq, the leader here ahead of those earnings, up 1.25%.
All right, Julie, you mentioned earnings, so let's get right to it, because that is our top story. Big names in big tech set to report after the bell today. We're going to get results from Amazon, Meta, and Apple in about an hour. Yahoo Finance's Dan Howley is here with what investors should be watching in those reports. So what should we be watching, Dan? Walk us through it.
All right, let's go over some of the big numbers and then the smaller big numbers that we're going to be watching. So for Amazon, we're expecting adjusted earnings per share of $1.04 on revenue of $166.2 billion. AWS, that's the main number that we're going to be watching. That's expected to come in at $24.2 billion. The reason why we want to watch that is because AI has been such a big discussion for everyone. And you have to remember that AI includes the cloud. The cloud is a major part of AI. Companies can't run AI services without the cloud. So seeing how much the cloud is impacting AWS revenue is going to be an important indicator of how much that's actually doing for Amazon. Let's move on to Meta, the other big company that's reporting. They're expected to post earnings per share of $5.05 on revenue of $39.01 billion, and obviously ad revenue is going to be the big important number for this. Anticipated revenue is supposed to be $37.8 billion. That would be up from $31.3 billion. And obviously we saw what happened with Alphabet when they announced on Tuesday they missed on anticipated ad sales, and so they got absolutely hammered as a result. You can see that drop off there from the report, and so that's going to be absolutely worth watching, as well as any kind of announcements about what they're doing with generative AI. And then finally, we have Apple. That's the monster. Expected $2.11 earnings per share on revenue of $117.9 billion. iPhone revenue, that's what you're going to be wanting to watch, $68.6 billion. More specifically, though, we're looking at China revenue, because the issue here is, look, a lot of analysts have said there's going to be problems with iPhone sales. How much then does that impact the actual number? How much does that impact Apple?
So big picture here, when we're looking at these guys, man, the expectations are high, right? The pressure is on, because what we have seen thus far from the large cap tech companies we've heard from, the reaction has not been good, in part because, we can all talk about consensus estimates all we want, but that doesn't really necessarily encapsulate the sentiment and the vibe and the hopes that are being put on these companies. I mean, you look at Meta, it's up 12% this year, just thus far, going into this print. Even after you got that disappointment from Alphabet that you would think would have some read-through from Meta, it's still been a rocket ship higher. So it's just really interesting here. I think the expectations game and what investors really want to hear from these companies is going to be so key. And I think, safe to say, for all of them, people want to hear more about AI, maybe particularly about Apple, because we haven't heard that much from them about it.
Well, it's interesting that you say that about Meta and Alphabet, right? Because we had seen Alphabet struggle with ad sales, but Meta do well. And the prior issues with Meta was the app tracking transparency from Apple. Kneecap their ad business, right? That along with, the rising interest rates, things like that really kind of hurt them, but they've managed to come back. And now I think people are expecting them to just blow things out of the water. They're crushing, as far as year to date, they're crushing Apple, Microsoft, Amazon. They're just blowing everyone away except for NVIDIA, which, I mean, come on, who's going to do that at this point, right? So the fact that they're doing that well, you're right, Julie, the anticipation is wild. If they swing and miss on this, it's not going to be good.
Yeah, I am interested too, Dan, just because you're taking, Julie mentioned Apple and AI, which is interesting, because I've spoken to some analysts, Dan, and they know Apple really well, and even those guys are they tell me they're kind of surprised a bit about how, in their words, Apple's been a bit quiet on generative AI. What do you think?
Yeah, I mean, their kind of MO has always been never emphasize the underlying technology as much, right? They'll talk about, predictive text. That was something that they came out with iOS 17, right? They had said, we're using machine learning, and then just kind of, that was it. That was the only mention, and then went right into what predicted text will do. So I think, as far as AI, Tim Cook has mentioned it a smattering of times, only when analysts ask him on analyst calls, earnings calls. So that, I think, is going to be key. What does he say in response to those questions? But overall, I don't think we're going to hear anything as far as AI, specifically generative AI, goes until iOS 18. If they kind of shift strategies and say we have to emphasize this, but as I said, their MO has never been that. They're not. They're not going to talk about. Okay, the Vision Pro, for instance, has a micro OLED display. Incredible technology. They make TVs with it, tens of thousands of dollars. Tiny mention from Apple. The screen is beautiful. So they're never going to emphasize that technology.
The bolts, the nuts and bolts, they're not focusing on. They're focused on the user experience. Is Amazon going to be the boring one today, you guys? Like, by comparison? I don't know. It feels weird to say that, doesn't it?
Dan is right, though. I'm to your point, Dan, AWS will be fascinating. That's the profit engine.
I'm curious
what do
about
they say
the
about
ad
that?
tier for
whether that
Amazon
surprises
Prime
to the upside.
Massive business,
All right, very exciting.
Got my right
Dan
fingers
Halley.
going.
Yeah, you better limber up there. Thanks, Dan. Appreciate it. Well, with so much focus on the Magnificent Seven, investors may be looking beyond mega cap stocks to help better position themselves. For more, let's welcome in Luke Kawa, UBS Asset Management Asset Allocation Strategist and former colleague of mine at Bloomberg once upon a time. Luke, everybody keeps talking about broadening beyond big tech, but they can't stop looking at big tech, until we started to get these numbers, that was borne out by the ramp that we were seeing in those stocks.
Yeah, I think it's certainly been the case if you look to why these stocks have had a lot of success. It's just a great amount of earnings growth in excess of the broad market. And it's been an environment where this has been the waiting for Godot recession, right? We've been calling for recession for the past 18 months and not really had those fears realized. If you think you're heading into an economic downturn and one never happens, well, that means to us there's a lot more room to have a refresh of the business cycle, to have a lot more breadth in terms of where profit growth is coming from. And I think you can start to see tentative signs of that in things like, today the new orders component of ISM manufacturing, it went above 50 for the first time in 16 months, suggesting that finally we're going to see inventory restocking, that build out a little more. That's more things you would associate with the industrial economy. That's more something you would associate with cyclical sectors doing well. I think in the near term, we really do will be focused on these earnings and as well how the U.S., whether there is a policy response, what investors' thoughts are on this little banking kerfuffle that seems to be happening in regional banks again. In Q1, I feel like I'm having deja vu. Yeah. But those will certainly be factors we're watching in the short term.
And Luke, does the market have to broaden out beyond mega cap tech? I mean, obviously that's a trend we've been talking about, but does it have to broaden out if it's going to keep rallying to the upside?
So, does it have to? No. Yeah. And that's just by virtue of the weight that these names have and the extent to which earnings have grown faster than the rest of the market. So, for instance, if you're looking at measures of advanced decline lines, how many stocks are rising versus falling, those pretty much peaked late last year and have been edging lower. So the reason we've rallied even this year so far has been a much more concentrated story. And don't get me wrong, beyond the broadening out, we still maintain exposure to this theme. We're still overweight U.S. tech, but the view here and the thinking here is if we look at this medium term in terms of what kind of things can drive a lot of earnings growth. Last cycle, tech was able to drive a lot of earnings growth just because nothing really grew, right? This time, I think we have more of a catalyst, and I'm sure Dan has a lot more insight as to what AI might be able to do down the road. Our view is more just that the build out of AI and companies are looking to implement and see what can be done. That's a pretty big catalyst to kind of lift all tides in tech for quite a bit and empower a good degree of earnings outperformance.
I mean, it's interesting because you wrote in a recent note, this is a little bit of a different flavor than we have heard. You talked about mid caps. Now, we've heard a lot of people talk about small caps recently. Mid caps has been less, at least discussed. So what is it about mid caps right now that you think is attractive?
One thing that in the mid cap versus small cap distinguishment is your choice of index is going to matter a lot. And I think the small cap index that folks would tend to focus on a lot, the Russell 2000 index, that's very growth oriented. That has a lot of companies that are more built on the expectations of perhaps major profit growth one day rather than anything they're doing consistent on a small scale today. Mid caps are the area where you're getting companies that do have proven track records, do have proven businesses, and in our view, it's more leverage just to the U.S. economy versus small caps. There's really a lot of leverage to biotech, which you can have a view on biotech. We have a stronger view just on the U.S. economy and the high likelihood of a soft landing, and the idea that a lot of the headwinds we've had over the past couple of years in terms of rates being high, interest rate sensitive sectors being squeezed, a long pulling forward of spending on goods that's been in decline. We see signs of that really reversing this year, and that's the mid caps really just fit the more ships rowing in the same direction type of vibe.
And Luke, after just the rally we've seen in the market so far, how does valuation look to you at these levels?
So valuation, it's one of the three pillars of our investment process. It's obviously going to be something that you care about. For us, it matters a lot when getting into strategic asset allocation, setting up portfolios for the very, very long term. But as I'm sure you know, and folks have gone on and said, in the short term, over the 3 to 6 to 1 year time frame, there is really no relationship between valuation and the direction of returns. What valuation can do, and what rich valuations today do say, is that the likelihood of very strong returns in the near term has gone down. But the most important thing, if you just get one thing to look at to determine whether stocks are going to go up or down over a 3, 6, 12-month horizon, it's what is happening to earnings estimates. As long as those are rising, your hit rate on stocks going up is very, very high. And based on our view of the economy, which is still a quite positive one, that's the environment we expect to persist.
And Luke, just quickly, I would be remiss if I didn't ask about the Fed while you're here, given that we just heard from Jay Powell yesterday. Were you surprised to see him say what seemed like pretty definitively that March is not happening?
Oh, quite frankly, yes. That did come as a surprise to hear, and it did come as a surprise to hear, so late into a press conference where, that would have been a headline that everyone would have appreciated a lot earlier. We could have tuned off and not golf season, and I'm not a golfer, but done something like that. But bigger picture, our view has kind of been, if the Fed is cutting in a month that starts with MA, and they're cutting because of good reasons, not bad reasons, good reasons being the fact that inflation on higher frequencies in 6 and 3 month is basically at target already. Labor market has normalized a lot, but is not deteriorating. As long as you're getting cuts for good news reasons, we're not too fussed about when the timing of that is.
All right, a month starting with MA and for good reasons. That's the target.
Yeah.
Yeah, Luke, thank you so much for joining us today. That was great.
Achievable, maybe, hopefully.
Appreciate it. Thank you, Luke. We move on. Let's get some tickers here. Peloton shares, they are sinking here after reporting mixed second quarter results. The fitness company's third quarter guidance also disappointing the street, Julie. So stocks in the red. By the way, it's already down about 10% this year, headed into the print. But the story is, yes, they're projecting revenue 700 to 725 million during their Q3. That is not going to cut it. The street was closer to 756. And by the way, that's a drop from the 749 in the year ago period.
This stock, man, I mean, this company just has not been able to catch a break. Yeah, you've got a few little feints in the right direction, but overall, you've seen it drop somewhat 90% from its highs where it was back in 2020, and everybody was buying a Peloton. And Barry McCarthy,
look at that chart.
Yeah, I mean, Barry McCarthy, rather, the CEO, has really tried to throw a lot at the wall to see what was going to work. Most recently, one of the efforts of Peloton was to forge partnerships with universities. And University of Michigan was the first one of these. well, it didn't really work. So he says, guess what? We're not really going to go ahead in the same direction with that kind of partnership. But, he keeps trying here. He has talked about that sales through retailers, including Amazon, including Dick's Sporting Goods, that those have been going a little bit better. But, it's just, I think that investors have sort of wrapped their head around the idea that this is not what it was once thought to be. That said, there are still a lot of subscribers on this thing, 6.4 million in the holiday quarter. It's still down. It's down 4% year over year, but that's still a lot of folks, a lot of eyeballs on those platforms.
Yeah, most on the street are still on the sidelines, including Truist. Here's what they told their clients today. They said, we believe that Peloton should be able to start growing sustainably again in 2025, but visibility into the ultimate pace of growth and its margin profile remain low.
Do you have a Peloton?
I don't, no.
All right, Etsy shares are jumping as activist Elliott Management has built a stake in the company and will also now have a seat on the board of directors. Mark Steinberg, who's a partner at Elliott, is going to join the board as of February 5th here. And, it seems like it is a relatively amicable.
Bloomberg citing sources says it was friendly.
Yeah, I mean, and they're in the statement here from the company. Josh Silverman says, the CEO says, we're excited to welcome Mark to the Etsy board here. So when you have a statement where you've got the CEO of the company commenting, the new board member commenting, the chair of the board commenting, it seems like it is, a situation where at least initially they're going to all try to work together.
Yeah, the stock did see a pop today, but it's been rough going. You are still down hard over the past 12 months, about 50%. By the way.
So not surprising then, perhaps, that an activist would get involved to try to turn things around.
Finally, let's take a look at Corteva shares. They are surging as the company sees the record-setting demand for grain, oilseeds, and biofuels to continue into 2024. Company also expecting continuing earnings growth and margin expansion over the next 2 years, Julie. So this is the seed company, agricultural chemicals as well. Remember, they spun off from Dow DuPont a few years ago, 2019. And bottom line, they're talking about farm demand driving profits, right? So Q4 adjusted operating EBITDA, that beats, and they give a forecast here. It looks like expecting 2024 EBITDA 3.5 to 3.7 billion. That was about in line with consensus, but good enough to send the shares higher.
Apparently, farmers were buying later than is typical last year, and that's one of the things that fueled the. I mean, you look at the shares there; they saw a big slump last year. So it looks like what investors are betting on now is sort of a recovery narrative here. One analyst over at Wells Fargo says the company sees demand on the farm as steady and still strong. And also, the same analyst said the company could reach 16% EBITDA growth next year. So it's that growth profile that investors are looking at today.
Yeah, higher today did fall about 20% last year.
Yeah, exactly. We're just getting started here on Yahoo Finance Live. Coming up, Royal Caribbean beating fourth quarter earnings, issuing strong guidance for the year, although the shares are down 1%. We're going to speak to the cruise liner's CFO on the other side. Also, big tech earnings on tap. We've got you covered with all the numbers from tech giants later today. Stick around, more Yahoo Finance on the other side. Royal Caribbean predicting smooth sailing ahead after reporting fourth quarter earnings today. The cruise line operator predicting earnings per share will grow at least 40% this year. Naftali Holtz, Royal Caribbean's CFO, is joining us now. Naftali, thank you for being here. I want to talk about the year and the demand that you're seeing here because the shares have been sort of up and then down today. And I have seen analysts express some concern that it's going to be tough as the year goes on to just match the demand that you have been seeing thus far. Can you talk me through the trajectory you're expecting for growth for this year?
Hi, Julie. First, great to be with you. I think, as you noted, we just finished reporting our earnings, and I think 2023 can only be described as an exceptional year. We saw acceleration of demand, and it really accelerated through the year, and we ended the year very, very strongly with yield growth more than 3.5 times what we initially expected, earnings double what we expected at the beginning of the year. And the momentum continued into 2024, and we are now experiencing a record wave period. And the best 5 weeks, booking weeks in the company's history were actually since the last earnings call. And that is really talking to the strength of our brands, the demand for our vacation, and just the health of the consumer. So we're seeing it across the board. We're seeing it in interest in our vacations, in booking trends, in pricing, and just the behavior on the ships once the customers are coming online. So we're seeing an exceptional demand, and we're very excited to continue to grow yields this year and revenue and earnings 40% year over year.
So, Naftali, demand sounds strong. I am interested to hear about what you're seeing internationally, Naftali, kind of the trends there, especially given, of course, the geopolitical conflicts we're seeing.
Yeah, we see continued strong demand actually across the board. Obviously, the American consumer has been exceptionally strong, and we continue to see that in some of our Caribbean itineraries. But even when we look into other areas around the world where we sell and the guests that we're sourcing from, we're seeing really strong booking trends, again, volume and prices across all our key itineraries, Caribbean, Europe, Alaska, et cetera. So it's really broad-based and really just speaks to demand across the board.
And you all have said, and you said today in the conference call, that the impact of what's going on in the Red Sea in particular is not that, it's not a huge impact for Royal Caribbean. Is that just, I mean, for lack of a better word, is that just luck that you don't happen to have a lot of cruises moving through that area?
Well, like last year, when obviously the conflict started in the Middle East, we actually repositioned several ships from the region, so we don't have any ships sailing there. So that already happened last year. So really, what is remaining is a few ships, smaller ones, that are need to cross the Suez Canal in the spring and the fall seasons. And we continue to watch that, and of course, the safety of our customers is our top priority. And we continue to monitor the situation and make adjustments as needed. But our guidance and the way we run the business is not for a perfect environment, and so we plan for a lot of things throughout the year, and it's already included in our guidance for the year.
And Naftali, when I think about your competition, I mean, of course, it's other cruise operators. It's also, Naftali, just traditional land-based vacation. What are the trends you're seeing there? Are you all taking share?
Yeah, our focus is actually not on what the other cruise lines are doing. Our opportunity and what we think is for us growth opportunity for the years to come is really stealing share from the land-based vacations. So the way we design our ships, our experiences, is really geared towards attracting the consumer and competing with land-based vacation. So we believe that we have continued to do that. I mean, Icon of the Seas just came last week. Really, this is going to be the ultimate vacation experience anywhere on the planet. So we continue to see that strength, and we want to keep stealing share from land-based vacation. And we believe we have the right products in the market to make sure that the consumers are going into our ecosystem. There's a pretty significant gap to land-based vacation in terms of pricing, and we think that that's another opportunity. So the value proposition is just remarkable, and with the experiences we have, we think we can continue to steal share from them.
Naftali, are you on the Icon right now, or are you on what ship are you on right now?
Yeah, so I actually was on Icon last week. With the family, it was an exceptional experience.
Well, I want to
right now I'm on Celebrity Summit. She will go into the 7-night Caribbean, but Icon is just remarkable, and so we're very, very excited to make sure that we deliver the best vacations here to our customers.
I want to ask you about Icon a little bit more, because obviously there was a lot of excitement about that ship, it being the largest, right, that has ever sailed. What does that bring to the experience? Why is sort of bigger better in this case? And what do you expect from a revenue and earnings perspective is that ship going to do for you?
Yeah. It's really what I said. It's the ultimate family vacation, and there's something for everybody to do. If you have a young family, maybe you're more interested in the Surfside neighborhood, which is more for young families, or maybe just the adult-only section, Hideaway. So there's really an amazing, experiences for everybody. It just takes it to the next level. The amount of food and beverage venues, the pools, the activities that we have, the Aquadome, which is my and my family's favorite. It's just taking it to the next level, and that's really the way we've designed those experiences. Every ship we bring, and obviously Icon is just kind of taking it to the next level, is expected to deliver tremendous financial results and accretive to our company as we continue to grow the business. So we're very excited to make sure that we deliver on the experiences and obviously delivering great financial results.
Naftali, it was great to have you on the show today. Thank you so much for your time and insight. Ferrari shares, they are charging higher after the automaker reported Q4 sales that topped expectations and sees momentum continuing in 2024. Let's bring in our very own Pras Marinian to go through the details. Pras.
Yeah, Josh, kind of a strong quarter here for a good outlook. You mentioned that revenue topping estimates up 11% year over year there. Delivery is only up 3% though, so they're really making some hay there with pricing. For the year, they also topped 1 billion euros in net profit, a record amount for the company. So again, Ferrari showing that luxury demand is still there. And then you mentioned talking about continuing momentum 2024. They're seeing that their revenue is going to hit 6.4 billion euros next year, another record potentially on 2.45 billion in adjusted EBITDA. So good, strong expectations. They said that the Purosangue SUV and the 296 hybrid sports car powered sales for them this year.
And I can't remember where I saw the comment, but I saw the comment somewhere that you can't think of Ferrari just as a car company. It's more of a lifestyle company.
Oh yeah, definitely. I mean, definitely. And
Yeah.
I also saw a stat that's something along the lines of 25% of new buyers are below the age of 40, which shocked me.
Considering the price of those cars.
Well, usually the people driving them are silver-haired sort of individuals.
Yeah,
but,
well, I guess that's true too.
I should talk, right? Anyway.
Let's talk about the other big headline, though, with Ferrari today. One that caused a little bit of a buzz among certain segments of our newsroom. Lewis Hamilton, the Formula One star, leaving where was he for a long time, Mercedes, to go to Ferrari. I mean, that must be quite a coup.
It's a huge shocker in the world of F1. It just confirmed about an hour ago. Ferrari announced it that Hamilton been at Mercedes for since 2013, a 7-time world champion, switching over to Ferrari, the most storied brand or most storied team in F1 history. A huge sort of, it's going to be a huge, big deal next year. Liberty Media is going to be very happy to have this sort of the buzz around that. The race will be kind of, I think, even more anticipated to see how Hamilton will do on this new team. He also has a very talented partner in Charles Leclerc, so that'll be a good kind of tandem there. But yeah, a huge coup for Ferrari to get him for the next, I think it's a multi-year contract. So that's going to be a massive, massive win for Ferrari. And for Mercedes, unfortunately, not that great.
Interesting. All right, Pras, thank you. Appreciate it. Coming up, we're continuing our week-long series, Options 101. We'll help investors navigate the mathematical complexities of trading options and make the best moves for their portfolio. Stay tuned. We've got more Yahoo Finance after this.
I am asking the team at Intel to go on the biggest corporate transformation, maybe in the history of technology, maybe in the history of the last 100 years. We are transforming this company.
Pat Gelsinger's vision and drive put the silicon in Silicon Valley. Intel chips are in everything: laptops, smartphones, even cars. He not only helped build one of the biggest and most consequential companies in the world, he also helped change the course of computing as we know it. But Intel hasn't been without its challenges, with stiff competition and manufacturing snags. It's no secret the U.S. semiconductor industry has fallen behind, especially to foreign competitors. Pat is making it his mission to put Intel and the U.S. chip industry back on top, and he's doing that by drawing on his own leadership skills, largely shaped by his mentors, past disappointments, and an undying passion for the job.
There are very few CEOs who start at a company at 18 years who, as I understand it, write out a mission statement saying, this is my dream job, to become the top position in this company, and here you are 40 years later. What do you think as you walk in through those doors every day?
This is the place I grew up. I joke that I went through puberty at Intel. The industry needs a great Intel, right? The technology role, rebuilding manufacturing, the seminal piece that plays for manufacturing in America, for the economic benefit, for the national security implications of it. We gotta make this work.
Intel was hit with the perfect storm in 2020. Already behind in manufacturing, the company got caught up in the global chip shortage and pandemic-induced halt to global trade, causing Intel stock to fall. Since then, Gelsinger has worked to rebuild Intel to its once iconic status and position at the front of technological development. And he plans to tap his mentor's no pain, no gain mentality to make it happen.
Let's talk about the journey you've taken to get here as CEO. You found somebody within the company that really guided you along. And I wonder if you can talk a bit about your relationship with former CEO Andy Grove. What did you learn from him that shaped who you are today?
Well, Andy ended up being the seminal figure. Everybody who I've seen who's become a great leader can point to key mentoring influences, because we all sort of get stuck at points in our career, or aspects of our personality that need to be sharpened, or as I like to say, it's a diamond in the rough. And Andy, I joke that mentoring with him was like going to the dentist without Novocaine, right? He was tough, he was hard, he would drive you to be better. And I mentored with him for 35 years, and he complimented me 4 times.
What did that tough love teach you about leadership?
I'm far less hesitant to give people the tough feedback that they need. And I think often, leaders are a little bit reluctant to really give that feedback. Oh, maybe I'll offend them, or maybe they'll quit and leave. But you became so endeared to Andy, right? Because you knew he had only one objective: to make you better. And when you have somebody who's giving you pure, unadulterated, blunt, and often hard feedback, but you know that their only objective is to make you better, wow, Right? He's just got to be challenged by it and motivated to be that much better.
That blunt feedback didn't just motivate Gelsinger, it propelled him through the ranks. In 2001, he was tapped to become the company's first chief technology officer. But nearly 30 years after he started at Intel, Gelsinger was pushed down as CTO. He then became the CEO of VMware, where he honed his leadership skills.
I was crushed. I was devastated in it. But that then began a journey of, I'll say, rebuilding my own character, right? Really looking more deeply at why that might have happened, what I could have done differently. And when I came back as the CEO of Intel, I brought a whole set of new experiences and a much deeper, better leader personally as a result of being crushed, learning in new environments, and now having the opportunity to come back to my dream job.
I recently heard you say that you've got 3 key factors that you think are, number one, key to success, but also that guide you in your leadership. I think the acronym is MAPS. How did you come up with that?
Well, mentoring had always been a key piece to me, always. So the M had been there since the early days when Andy picked me out and started to challenge me. And as I came back to Intel, the A became pretty profound, audacious goals. And this idea that you really are looking at things that are beyond you. I have no idea how I'm going to get there, but I'm going to keep working to put myself in positions that allow some of those goals to come true. And the last one, P, is passion, right? What are you passionate about, right? Because if you're living and working inside of your passion, the days are short as you progress. You wake up each day just so enthralled by that opportunity. And this idea of, working on technology that touches every person on the planet, yeah, that's my passion.
Gelsinger will need to draw on that passion for technology in order to take on what could be the most audacious goal of his career, bringing chip manufacturing back to the U.S.
In the 90s, the U.S. was manufacturing roughly 40% of the world's chips. What happened?
Yeah, a couple of things, happened. The view was, hey, we can outshore manufacturing. There's this emergence of the foundry model in the industry. Let's have somebody else do the hard job of manufacturing. And all of a sudden we're realizing, wow, we've put ourselves as a nation, as the Western world, into a very precarious situation. Hey, I'm excited to be part of this effort to say, no, we need balanced, resilient supply chains for the world. We will build world-class manufacturing and technology. Manufacturing and innovation are coterminous. You must be doing both of them together if you are going to be a leading technology provider in the future.
Finally, if we can bring it back to your personal story. You talked about the importance of having a mission statement, having goals that may not be attainable, but aiming high. How has that mission statement changed for you?
I look at my mission statement through the lens of my 8 grandchildren. It's about, what do I want to do that lives long beyond me? If I could be, looking back at Intel 20, 30 years from now, that I could see a company that is thriving, growing, more impactful after I've gone. Also, that I could look at the U.S. and be able to say, we've created millions of new manufacturing jobs, and that overall the U.S. remains at the front end of innovation in all the key areas.
Selecting the right option strategy can be a daunting task, but don't fear. We're going to be breaking down which option trades are best given the current market environment in today's installment of Yahoo Finance's Options 101 Theme Week, sponsored by Tasty Trade. And joining us here to discuss is Sean McLaughlin, All-Star Chart's Chief Options Strategist. Sean, thank you for coming here today. I want to show the viewers at home the Wi-Fi interactive, and hopefully you can see this too. I've been showing this screen all week. We have calls and puts. You can go long a call, and that gives you the right to buy a stock. You can also short it. That gives you the obligation to sell it, and vice versa. But what I want the viewers to see is a quadrant system that you come up with to help you find the right options in the current market environment. We have a scale going up and down of bullish to bearish, and then from left to right, low volatility to high volatility. And we've put one example of what you can do in these different quadrants, but there are many more strategies. Could you just kind of break this down for us?
Sure. Hi, Jared. Thanks for having me. And what we're looking at here is just a sample of ideas that one can do based on the implied volatility environment that we are in currently. So I've seen the episodes you guys have done so far this week. You're doing an excellent job of covering a lot of the basics and options. The next step when you're about to put an options trade on is you don't want to just buy a call if you're bullish or buy a put if you're bearish. You want to take implied volatility into consideration to stack the edges in your favor. Because what happens is in a high implied volatility environment, you are going to pay a higher premium, for example, if you're buying just a simple call, right? And if you're paying a higher premium, that makes it harder for you to earn an acceptable return if you get that trade right. On the flip side, if volatility is if volatility is low, then premiums are very cheap, and you don't want to be doing credit spreads. You don't want to be selling strangles, things that bring in premium, because you're not getting paid enough to compensate for the risk that might happen if a directional move happens in the wrong way or if volatility were to rise. So knowing the volatility environment is key to selecting the strategy you want to use to maximize your odds of success.
All right, and the VIX has been pretty low lately, at least on the indices. We've seen some pretty low implied volatility, but I want to break down a couple trades on the Wi-Fi Interactive here. We're taking a look at Mosaic, that's ticker MOS, and you're looking to buy the $30 put with an expiry in June of 21 this year, and we have a profit and loss chart. Could you kind of break this down and how you're thinking about it and how that ties into what you were just describing?
Sure. Well, this is a trade that doesn't come along very often. Typically, when a stock is breaking support and getting to lower levels or the lowest levels it's been in a while, you tend to see people, hedgers, people who are long, who are worried about the position, they tend to use the options market to insure against a large loss. So they'll purchase puts to protect their long position. And when they're purchasing puts, that drives the premiums of options up. But in this case, in Mosaic, right now, at least the time we put this trade on yesterday, the implied volatility in these puts were very cheap, the cheapest it's been in for most of the past year. And so we saw an opportunity where the analysts or the analysis that we've done here at All Star Charts, we think that Mosaic, if it follows through on the downside, could trade as low as $23 over the next couple of months. So we saw that the June 30 puts were trading for $2 a contract. If Mosaic gets down to 23 before June expiration, those puts will be worth at least $7. That's what the intrinsic value will be at that point. Then we're looking at least a 3x return on our $2 investment, which is what we paid for those puts yesterday.
That seems quite attractive. Great risk reward. We have time for one more, so I want to get quickly to this next trade, which is Lululemon. You're doing a bear put spread, and just quickly for the viewers here, a bear put spread is when an investor purchases a put option while selling the same number of puts at a lower strike price on the same stock, and that's with the same expiration. So here we're buying the 420 puts and selling the 380 puts with an expiry of April 19 for Lulu. What do you think about this? Break it down for us, please.
Well, with the Mosaic trade, we just simply bought puts, right?
Yes.
In this case, we're buying a put spread, and there's two reasons why we did a put spread. Number one, the implied volatility in Lululemon options was a little bit more elevated, so it was more expensive to just buy puts in volatility terms. Also, the fact that it's a nearly $400 priced stock means that options just in absolute terms are more expensive. So by creating a spread, by buying one put and selling the further out of the money put, we lower our cost of participation, we increase our odds of success. And if Lululemon can't hold the levels that it's at right now, or I'm sorry, if it can stay below the levels where it recently was, we think that there's a failed breakout in play here in Lululemon. We think there's a lot more downside to go, and we're looking at maybe 390, 380 over the next 4 months.
All right. Really appreciate you stopping by here for Options 101 1 week. Sean McLaughlin of All Star Charts. Stick around, all your market coverage when we return.
The Fed has a tough path to walk in the months ahead when navigating timing on interest rates cuts. That balance made all the more difficult by the upcoming presidential election. At yesterday's news conference, Fed Chair Jay Powell insisted that politics will not affect the committee's decisions.
It's not something I'm focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
With more, we're joined by Nick Timiraos. He's chief economics correspondent at the Wall Street Journal. He was, of course, at that press conference yesterday. Nick, it's good to see you. So, I mean, they're humans, right? And so they're aware of what's going on in the world around them. And it's going to be tricky to not at least show the appearance that they're sort of favoring one candidate or the other, right?
Well, you're right in that the stakes are high here, but I think it's because the stakes are so high. If you're the Fed, you've got the economy right now almost right where you want it from the standpoint of inflation's looking a lot better than it was 6 months ago, but the economy hasn't slowed down nearly as much as you would have expected to get that disinflation. So if you're going for the soft landing, you've got a chance here. And I think that in some ways makes it easier to kind of tune out the politics because, at the end of the day, pulling off the soft landing is going to be more important and memorable than almost anything else here.
Nick, you make a good point in your piece I wanted to go over with you, which is you note that, listen, the Fed can always impact economic and therefore political outcomes. But your point in the piece there, Nick, was that perhaps the potential for that is heightened this year. What did you mean by that?
Well, the Fed's interest and the interest of the president are not always aligned, right? Because if the president is running for re-election, and I'm not talking about Biden per se, but any president running for re-election is going to want the economy to be as good as it possibly can be in the next few months. The Fed's interest is for there to be a good economy, but they're going to take a longer view. And so I think that's the challenge here for the Fed is how do they tune out some of the political noise? They're going to be under pressure. There's going to be pressure from Democrats when Jay Powell testifies, probably next month on Capitol Hill. Why are you holding rates so high if inflation's low? And there could be pressure if the Fed goes too soon, as seen by Republicans as going too soon and saying, well, wait a minute, what happened to your focus on inflation? I think, key point here is that it's not like there's only risk on one side still. There's risk on both sides. There's risk that inflation stays too high or reaccelerates. There's risk that the economy slows down too soon. And so even if you were trying to be political about this, it's not clear exactly which way you go here. And I think that does help the Fed in some respects because they can just focus on trying to keep inflation down with a solidly growing economy.
We did speak to former Dallas Fed president yesterday, Robert Kaplan, about how the Fed, obviously he has experience. So we talked to him about how the Fed sort of thinks during an election year. And this is what he said.
So having been there during two elections now, 16 and 20, what you try to do is think what is the right thing to do for the economy? You screen out political considerations or political influence. I think the one thing you would do is as you approach the election, I think I'd be careful not to want to make unnecessary moves or abrupt moves.
And Nick, I wonder if that last part sort of implies that if the Fed acts, it will act with sort of a buffer timing-wise before the election, or might be more likely to do so.
I think Rob makes a good point. I talked to some other former Fed presidents who made the point that politics won't influence what the Fed does. It won't influence the timing or the strategy, but it could influence, the care that they take in communicating around what they're doing. They always try to communicate what they're doing, right? That's why Jay Powell has a press conference after every FOMC meeting. But I think it puts an onus on the Fed to be extra clear in explaining why you're doing what you're doing. You're not making sudden sort of hyper-discretionary moves. I think that's what Rob Kaplan was talking about. You're explaining what you're doing. You're trying to make it look like you're following a plan. You're not deviating from sort of standard operating procedures. And so I would expect to see the Fed leadership try quite hard and again, they always do this to some extent, but you're going to be very, open about, well, here's what we're doing. If we're cutting rates when the economy's strong, here's why we're doing that. You sort of have to make the case here for whatever it is that you're doing. And then, the Fed is probably going to hope that something crazy doesn't happen in September and October that requires them to do something that is, unpredictable. But, September 2008, we did have unpredictable. And so when events arise, the Fed is going to respond to them. They're not going to say, well, it's an election year, so we're not going to do the thing that we would normally do. You can definitely overthink these things.
Nick, always love having you on the show. Thanks so much for your time.
Thanks for having me.
Coming up, big tech earnings are set to cross after the bell. We're going to break down the latest numbers from Amazon, Meta, and Apple when Yahoo Finance returns.
There we have the closing bell on Wall Street. So let's do a check of the markets here as we have seen this rally for all three major averages after the sort of, volatility, turmoil, angst that was brought on by Jay Powell speaking yesterday. Today got a pretty solid rally on our hands with the Dow up about 370 points, the S&P rising by about 1.25%, and the Nasdaq up 1.33%, Josh.
Stocks rebounding on Wall Street, closing near the highs of the day here. Jared Blickery is here with a look back at the day. Jared.
That's right, Josh. Reversal of fortune from yesterday. The Dow, by the way, closing at a record high. 38,487 was the prior. Now we got 38,520. And let me go to the Nasdaq because that's up even more. That's up 1.3% today. You can see it has clawed back quite a bit of the loss that we had yesterday, but not all of it. And so we're going to see if we can fill that gap in the days to come. But we want to break down the sector action for today, and it has been about retail. Staples, consumer staples in the lead, followed by consumer discretionary. Both of those, the retail sectors up 2 and just shy of 2% respectively. Utilities, real estate, industrials, materials also outperforming there, along with healthcare and tech, by the way. Lots of 1%ers and above. Even XLC, that houses Meta and Alphabet, up 1%. Only energy taking it to the downside. The other value sector, financials, also pretty low on the totem pole, but in the green to close the day. And here we have NVIDIA up 2.44%. Amazon, we're going to be bringing those earnings to you in a few minutes there. Meta up over 1%. Apple also clawing back some of those losses that they've had this year, trying to get back up to that break even. And let's take a look at some of our leaders, and we can see a lot more green than red. This is a flip of yesterday. Guess what? KRE, that's regional banks, those ended in the red for the second day in the row. It was a big loss for them yesterday. So we'll be keeping that in the mind for the future. But cannabis, that's MJ, that's up 7%. We also have retail, I mentioned that, home builders, solar, and gambling. Each of those up more than 2%. So let me just close here on the retail sector. I promised a little bit of that, and we're going to see consumer staples winning the day with Walmart and Costco, each up more than 1.5%. Guys, and I hear we got a little bit more time, so let me just go back and I can actually take a look at the Dow, some of those winners and losers today. Now we got a little bit more red than we do on the Nasdaq 100 screen. JP Morgan Financial ending the day in the red. It has been hitting record highs recently, but not today. United Health down about 1%. J&J also in the red, and Honeywell down about 2.5%, guys.
Jared, thank you very much. Appreciate it. We got Amazon earnings. We're starting the deluge right now. So Amazon earnings coming out at $1 per share. That is better than the 78 cents that were estimated here. Overall net sales in the fourth quarter, about $170 billion. That too ahead of estimates for about $166.2 billion. And then let's zero in on some important stuff here. First of all, AWS, excluding the effects of currency, AWS, Amazon Web Services, that is its cloud business, rising 13% in terms of its revenue in the fourth quarter, the estimate for a gain of 11.8%. So AWS sales beating estimates. And then finally, I want to mention the forecast for the first quarter. So first quarter net sales seen as $138 billion to $143.5 billion. The estimate from analysts was $142 billion. So the midpoint from 138 to 143 actually leaves it a little room potentially to miss, but that upper end maybe comfortably above in the eyes of investors here. So from what I see thus far, the only thing, Josh, that I see that was a little bit shy of estimates was physical stores, i.e. mostly Whole Foods, but not entirely, but mostly, at $5.15 billion. That's a little bit shy of estimates, but otherwise, mostly pretty much a beat here.
Yeah, you can see the immediate reaction. Investors, at least initially here, clearly like what they see. And I think, just to zero in on the AWS, the cloud computing business, is so critical because that is this company's profit center. And so to see net sales up ex-FX 13%, that does beat. Street was around 11.8%. And now investors really want to hear about, okay, what does growth kind of look like over the next few quarters? Not just growth for AWS, but also margins, and what are the drivers there going to be?
Yeah, I mentioned that the sales forecast for the first quarter, the midpoint's a little below the average estimate. Operating income, however, is above.
Getting a headline.
And let's remember, Amazon usually trades, it feels like to me, correct me if I'm wrong, trades more on profitability than it does right on sales, at least as of late. And operating margin in the fourth quarter also beating estimates, speaking of profitability, at 7.8% versus the 6.2% or so that analysts had been predicting. The operating income forecast of 8 to 12 billion, the midpoint of that above the 9.1 or so billion that analysts were estimating. So profitability here is working for the company. So that seems to be something as well that is helping matters.
All right, well, let's get to a guest to talk more about this one. A big day today, capping off a huge week for tech earnings. Amazon reporting just moments ago, Meta and Apple announcing earnings later today. Our next guest thinks this has the potential to move markets significantly after the Fed's comments yesterday led to that late afternoon sell-off. For more on the big week from big tech, we're talking to Rockland Trust Executive Vice President and Chief Investment Officer Dave Smith. Dave, it's good to have you. We just got Amazon out initially here. Investors like what they see. You see the stock jumping about 5% in the after hours. So we've had a few big tech prints now, Dave. We've got Amazon, of course, also in Microsoft and Alphabet. We got Apple and Meta on deck. So far, Dave, as you've been kind of working through these earnings reports, reading them, listening to on the calls, what do you make of what you heard so far from big tech?
Yeah, so far so good. I think obviously the reaction yesterday to the Fed was part of the equation, but also we had slightly mildly disappointing results from Google on Tuesday afternoon, which I think impacted the markets yesterday. And then obviously the New York NYCB, the community bank in New York City, taken a large charge with two drivers in addition to the Fed yesterday. Today, a bit of a recovery. Really good to see the Amazon results after the close here. Most importantly, the beat on AWS, which is really the profit driver for the company. So coming in at 13% revenue growth is better than expected. Still below its competitors. I think both Microsoft and Google have a little bit more growth in their web services business. But at the end of the day, everybody's kind of meeting or beating expectations in that critical line item. So far, so good. One down, two more to go today, and we'll see how we finish the day in the evening and see what that means for tomorrow.
Well, listen, not to give my producers who are still scrambling to do graphics a heart attack, but Meta's in the plus column as well here, Dave. I'm going to say out of the gate here as well, the company's revenue forecast beating. It's going to pay a dividend of 50 cents a share. We're going to dig more into those numbers in a moment. But how badly does the market need these beats right now after those couple of disappointments?
Well, I think it's critical. I mean, we all know that what if you want to call them the Magnificent Seven, if you take a couple out and call them what you want, but these big technology-oriented companies make up a substantial portion of the S&P 500. So their performance in any given day, if it's significant, it's going to move the benchmarks. It just is what it is. You can still add value, outperform by buying around those names. But at the end of the day, when people think about how the markets are doing, these companies are driving the results of the benchmarks. It's just the fact of the situation that we have at the moment. So it's good to see. And ultimately, these have secular growth trajectories that we think are part of the equation. But there's also some cyclicality to them because they've gotten so big that they can't help but be impacted to some extent by what's going on in the broader economy. So positive trends are really good.
And Dave, though, when you look at, we have both Amazon and Meta surging right now in the after hours after these prints. Plenty of investors might be, viewers might be watching this, Dave, right now and think, you know what? Big tech worked in 2023. They see results like this. They think, you know what? I'm just going to stick with big tech in 2024. Is that what you would advise, or no, you got to pick your spots more carefully here?
I think you have to be careful. The stocks have all kind of rallied together through 2023, and I think the business models are so dramatically different. I mean, if you think about Tesla, for example, and what drives its fundamentals and compare it to a company like Google, it's very, very different. Now, interest rates obviously have an impact on valuations, particularly of high growth companies. So there's an impact to them and from a price point on what's going on with interest rates. But the fundamentals that drive the top and bottom line of these companies are dramatically different. So I would expect to see some dispersion. We've already sort of seen it to start 2024 where Tesla sort of disappointed and its stock has not been performing in conjunction with the rest of the group. And I think there may be more of that as we progress through this year. I hope that's the case because ultimately you would expect investors to be able to discern the differences in these various business models.
Dave, thank you so much for your time. I'm going to leave it there because we are going to dig now into what's going on with Meta. Meta just out. Let me get straight to the cash return to shareholders here. The company, as I just mentioned, is going to be paying a quarterly dividend of 50 cents per share and is boosting its buyback authorization by $50 billion, a sizable buyback coming from Meta. Now, what are the numbers here for the earnings that the company is announcing as it announces these cash returns to shareholders? Most of the numbers are coming out ahead of estimates as well. Daily active users across the Meta platforms here, daily active users at about 2.1 billion, monthly active users at about 3.1 billion. Both of those pretty much in line to slightly ahead of estimates here. At the same time, the company is coming out with fourth quarter earnings per share of $5.33, beating the average analyst estimate of $4.91. We were talking about what we were looking for ad revenue. Ad revenue, $38.7 billion. That is very slightly short of estimates here. However, the company's first quarter revenue forecast is really getting some attention here too. $34.5 billion to $37 billion. The estimate for $33.6 billion. Listen, I know that was a lot of numbers. The bottom line is here, this is a fairly solid, would I even say spectacular beat on the part of Meta, and that buyback boost is definitely eye-popping for that raise of the buyback authorization by $50 billion.
We should note also now lifting shares of Snap and Pinterest in the after hours. A couple of big themes. One is AI. It's a big investment area for Meta. It'll be very interesting to hear the execs talk about that and the kind of impact that's having in terms of just usage and ad spending. Also, remember, a big reason investors piled into this one too last year, Julie, they liked what Zuckerberg had to say about the year of efficiency, right, at this company, meaning he was determined to get this company leaner and meaner. And some bulls we're banking on that continuing. So interesting to see a headline drop here that as of December 31st, headcount's down about 20% year over year.
But guess what? The year of efficiency is over, Josh Lipton, because you know what else they said in this statement? We anticipate growth in payroll expenses as we work down our current hiring underrun, and add incremental talent to support priority areas in 2024. So they say that's going to shift workforce composition toward higher cost technical roles, but it also means they're going to be hiring. So that's an interesting. So maybe the efficiency.
Well, they're down. They
gear.
do say their headcount is down 20% year over year.
Right.
So if they're hiring, I think investors will give you some leeway depending on where you're hiring.
Fair.
Right? Yeah.
Yes, most definitely. A lot to dig into here. So coming up, as we said, Meta higher after beating fourth quarter earnings, coming out with that strong first quarter forecast. We're going to break the numbers from big tech giants. Well, we're still waiting for Apple. We're going to discuss all of this as well on the other side. We'll be right back. Shares of Meta are soaring in after-hours trading. The stock up 11% as Meta announces its first ever quarterly dividend, boosts its buyback by $50 billion. And on top of all that, blockbuster guidance for the first quarter. Aaron Kessler, Seaport Global Analyst, and Scott Devitt, Wedbush Securities Managing Director, both joining me right now. I don't know if you guys are sharing my enthusiasm here, or it's just fascinating that we get these numbers, especially after the big tech disappointments of the past couple of days. Aaron, let's start with you. Just give me your sort of high-level meta reaction here.
Yeah, results were strong. I'd say at the high end of the guidance for Q4. Not a big surprise. We think they guided a little bit conservative given kind of the October 7th events and just the uncertainty following that. But we saw some relatively strong results from Google and with YouTube. But I think the more important thing to your point was the strong guidance for Q1, got it essentially above the street for revenues for Q1. And then the dividend, obviously investors are going to like that, showing continued expense discipline on their part. And so I think investors are really more focused probably on the guidance and the dividend for Meta.
And what about you, Scott?
I would just add that they also kept their annual OPEX guide for 2024 equivalent to what they said last quarter, which is different than what Alphabet did in raising CapEx expectations. So when you think about the two stocks relatively now, the setup for the year, which is being priced into Meta, is just a lot more favorable for it versus Alphabet. The narrative on Alphabet is now that to address the search challenges that AI brings, it requires incremental cost in the business. And whereas with Meta, AI looks like it's more of a tailwind. So you get incremental growth from Meta. The multiples are relatively the same. And the cost structure at Meta is a bit more sound. At least that's the way it looks right now.
It is perhaps a bit more sound after the year that they have had where they sort of retrenched, but it looks like now there is a bit more investment that's going to be going on the part of Meta, right? Not just in returning cash to shareholders through the buyback and the dividend, but also making clear in the statement that they're willing to hire and expand in what they call higher cost technical roles because of that investment in AI, right? Scott, do you think that investors who at one time were not happy about that investment are going to be more understanding if they feel it's being, deployed in a reasonable way?
Yeah, well, this company's flipped the entire narrative. You had content issues, Cambridge Analytica, Apple IDFA, TikTok's going to kill Meta. It's now flipped to Reels has addressed Meta. Advantage Plus has addressed Apple's IDFA. The company's spending, losing $16 billion trying to find ways to generate revenue in this next AI cycle with AR, VR devices, AI smart glasses, Llama, the infusion of AI into the business. So it's become a growth story again overnight, and that's been the fuel behind the recovery in the stock. But this narrative has done a 180 in that window, and I think the move is justified. Before the move here after hours, you're looking at a stock that was trading around 22, 23 times current year earnings.
At the same time, it's so fascinating that we get this release on a day after the CEO of the company was effectively shamed into standing up and apologizing to parents because of mental health issues that his platform has allegedly caused. So, Aaron, what do you make of that sort of juxtaposition? And Meta does acknowledge in the statement here that there are regulatory headwinds.
Yeah, no, it's true. And they have taken steps to work with regulators. I think they put out a few things recently, specifically around Instagram and working with the regulator, with the government to kind of restrict certain types of content that teens see. So we all know these services can be very addictive, and we don't think that'll probably stop. But I think at the same time, Meta is taking actions to kind of alleviate some of those concerns for parents. And they have to do that. It could have some negative effect on kind of revenues. We're gonna obviously have kind of a wait and see, but one thing we will be focused on the earnings call will be any potential impact from the more restrictive content in terms of engagement with a younger audience.
Scott, is that a concern for you at all?
Well, at the moment, they're two separate topics. There is what is social media's impact on society, which if you ask my personal opinion, and I'd probably say it's a net negative, but the company exists. If not Meta, would be somebody else. They're putting protections in place to do the best that they can as a company, and the financial, rewards for that are quite significant. It's a highly profitable, business approaching 40% margin, and becoming, the second most dominant it is the second most dominant advertising company in the world. So those questions are at times tied when it's affecting the business. I don't think the regulatory, construct or changes that are put in place around events like you were discussing from yesterday or anything else that's going on are really going to change the trajectory of growth at this point.
A moment to linger on the ads here for a second here, because the company talking about average price per ad up 2% year over year, and that impressions delivered across all of the Facebook or apps, or Meta apps, I should say, were up by 21%. Aaron, this seems to be a contrast with what we heard from Google, right? What is it that you think Meta is doing right on this front?
Yeah, I mean, it's often difficult to compare. A lot of times it's a mix shift or geographic and have a big impact on that. I would say we've seen stronger results, specifically on, I think Reels are starting to see better pricing. That came out very low in terms of pricing on Reels initially, and Reels pricing has gone up. We think video pricing is going up overall for a lot of the platforms. So I think that's helped Instagram as well as Facebook. And you're getting easier comps as well on a year-over-year basis. So that's really helped pricing if you just look at it on a pure year-over-year basis.
Guys, I want to shift gears and talk a little bit about Amazon and the numbers that we got from that company. Those shares are rising after reporting its fourth quarter earnings. Not quite as eye-popping, I guess, as Meta, but still not too shabby to see the shares up by 5%, and in particular after the sales increase of 14%, and then the sales and, importantly, operating income forecast for the company's current quarter. Scott, I'll start with you on this one and kind of, again, high level, what stands out to you about Amazon?
Well, the operating income in the quarter is a massive beat. They guided at the high end at $11 billion. The consensus was below that. We were above that. $11 billion, the guide, just to be fair, was lower than what they reported in the third quarter, which only happened 2 times in the company's history, and that was during the post-internet bubble period. So it seemed pretty clear they were going to clear that hurdle. But at $13.2 billion, which is what they did in the quarter, you have a trajectory that's, leading the company towards kind of a 10% bogey in 2025 now, which is not something that investors were expecting. So the underpinnings of the business now, with the health of the retail business post-pandemic, the success of the advertising business, and now the recovery of AWS, supported by rising margins, we think Amazon has quite a long way to go from here.
And the level of complexity at Amazon always is kind of amazing in terms of all the different businesses that they're running. So if we look at where these sort of efficiencies are coming from, that's allowing them to boost that operating income, Aaron, what do you think that they have really improved the most here?
Yeah, there's 2 key things. One, I'd say on AWS, which is a very high margin business. I think it was around 29% last quarter. We probably in the high 20s this quarter as well. So that's just a mix shift towards faster growth. Advertising is obviously a very high margin business that grew 27% year over year in the quarter. And then on the retail side, they've talked about better regionalization and shipping costs, which are reduced because of that. And so they've gotten really more focused on cost structure within the retail business. And so this is really starting to all come together now. Really kind of retail costs are under control. AWS had some reductions there, and then advertising still growing like gangbusters. So 2 of your high margin businesses seeing nice growth, and retail seeing better operating margins as well.
Well, and on that same point, Scott, how are you thinking about sort of the synergies between all these businesses? I mean, they talk a lot in this statement about, they've got, obviously they have Whole Foods, they have One Medical now that they're adding on as an additional subscription option for Amazon Prime subscribers. They've got the new ad tier on Amazon Prime, for that matter. Like, is everything sort of working in concert, or do investors need to think of this as just all of these disparate businesses?
I don't think it's disjointed. I mean, you bring up Whole Foods and healthcare, that maybe is a topic for a different conversation. But if you think of Amazon, in 5 pieces, the retail business is first party, third party, and a logistics business. There's an advertising business that's success is driven by the ownership of the marketplace. And then you have AWS that was built out of the infrastructure of Amazon. You could get away with AWS being a separate entity, certainly. But when you think about the AI aspects of the business now, with a cloud business integrated into that operation, I'm not sure that that's the case either. So at a high level, these are all very well integrated aspects to the business. Healthcare is a huge bet on the future. and layering that into Prime, because it's a huge problem that consumers have that Amazon is attempting to help them solve. That makes sense. Whole Foods, it's a project that's, I think they're still trying to figure out. If I'd say there's one thing in the business that's, not going as well as maybe anticipated, it would be that grocery business where they could still do quite a bit more work to make it better.
And then, Aaron, finally, when you're looking at Amazon, is there anything you don't like in these numbers, or is there risk that you're paying attention to going forward?
Yeah, and I think clearly on the call, I think the AWS growth rate will be a big focus for 2024. The AWS growth was slightly below our estimate. We're at 14%, but largely in line with the street for Q4. We would like to see AWS get back to mid-teens growth for 2024, and so we'll look out for any additional commentary on the conference call with regards to kind of the growth rate into Q1 and potential for 24.
Aaron, Scott, thank you so much. Really helpful context here as we try to make sense of these numbers, these rapid fire numbers coming at us. Really appreciate it. Thank you.
Great, thank you.
And of course, we're not done yet. There's one more coming. Apple's on deck on the other side. We'll have the latest numbers from Apple with investor attention focused on iPhone sales. Keep it right here.
Apple's first quarter results are just now hitting the wire. Let's get right into those numbers. EPS $2.18. That is a beat. The street was closer to $2.11. And importantly, revenue is up 2% to $119.6 billion. That is also a beat and does break that trend. So Apple returning to growth here on the top line. Also critically, gross margins, 45.9%. That is also better than expected. And let's just turn quickly to the segments. iPhone clocks in at $69.7 billion. That is better than consensus. Services does come in a touch light, $23.12 billion. Street closer was to around $23.4 billion there. Mac, $7.78 billion. iPad, $7.023 billion. Wearables, home and accessories, remember that includes the watch. They don't break that out specifically, but that division, $11.95 billion. Street was around $12 billion. Greater China, $20.8 billion in the quarter. Consensus was closer to $23.5 billion. And remember, China was a bit of a concern heading into this print. And one more data point we want to bring you here. Apple now saying their installed base of active devices has now surpassed 2.2 billion. That is also a very critical metric if you were an Apple investor. That's referring to the number of active devices in people's hands all around the world. That's important for future upgraders and important for people who want to subscribe to those services. But bottom line, beats on the bottom and the top here, Julian. Of course, now we wait for guidance on the call.
Yeah, and as we wait for guidance, we see the shares down 0.75%. I suspect that has something to do with those China revenues, perhaps. That looks to me at first blush like the biggest source of miss here within the numbers. Yes, the overall revenue beat, but revenue in China at $20.8 billion is short of the $23.5 billion that some investors were looking for. And this is not a shock, I don't think, because we had been getting reports in recent days that some of the shipments in China were looking perhaps a little bit lighter. And it's also not a shock because, listen, we know what's going on in China, right?
Yeah.
We know that there is weakness there in the Chinese economy.
Yeah, this was, for sure, China was a source of concern for some analysts. We spoke to some of those analysts, and you had seen these recent downgrades. That was one issue here, and people were talking about a shaky economy over there. They were also talking about, of course, the local home team, the rival, Huawei, and what kind of impact that's having. It'll be interesting to see how that shakes out in the call, how they address that question. Remember on the call, we don't get any longer formal guidance from Apple, but we do get detailed color and commentary. Top of mind, I think, for analysts besides China is going to be, listen, when they listen to Tim Cook and the CFO, Luca Maestri, how do they think about top-line growth over the next year, right? We return to growth this quarter. That's a big break. What do they see ahead?
Yeah, and we see the shares kind of swinging around here in after-hours trading here. It is interesting to me that we saw a slight miss on that service revenue number because so many analysts and investors, part of their investing thesis for Apple, going forward has been tied to services. One other thing I just want to mention here is Tim Cook gave a shout out in the statement to a product that is not out quite yet. That's the Apple Vision Pro.
Tomorrow.
Coming out tomorrow. The reviews have been, I think, pretty darn strong.
Yeah.
But with concern over the price tag for it, which I think is $3,500, right? But he does say, as customers begin to experience the incredible Apple Vision Pro tomorrow, we're committed as ever to the pursuit of groundbreaking innovation. Now, will that end up being more of a profit driver for the company? It's too early for that, right? But it is interesting that he does mention that.
We got smart people that asked that very question.
Yeah.
Coming up right now.
Let's do it. All right, here for a closer look into Apple's latest quarterly results, let's get to Santosh Rao. He is Manhattan Venture Partners Head of Research. Hey, Santosh. So as we look at these numbers from Apple, do you see sort of the services and, importantly, that China number as a disappointment?
Absolutely. I think these services is their big anchor in this whole, as the top line iPhone revenue kind of stalls or comes down. But I think services revenue is an anchor, needed to grow. Overall, China is a big concern. That's dropping. We knew there were issues there. So I think these two things add up. The number is a miss overall, but I think it's not a major disaster. I can see them coming back, the stock kind of trading in the range, because it's all about the future here going forward, how they get the generative AI into their whole mix and all that. So there are a lot of other levers that they can pull, but at this point, it is definitely a disappointment that two areas that we were concerned about did disappoint.
And on the call, what would be your top question for Tim Cook and Luca Maestri now? Is your top concern what top line growth looks like over the next few quarters? Is it margins hanging in there, which they did, by the way? We should call that 45.9%. That was a beat, but what would be your top questions for them?
Well, I think that's a big. I think we want to know what's the next catalyst. I mean, that's the biggest issue with Apple. You're trading at 30 times earnings. Revenues are kind of down, flat to down. The market's giving you the benefit of doubt. But what is the next catalyst? What are you giving us? So I want to know what's going on in China. Well, I want to know what's your next. How you are. What's your strategy with AI as it relates to your whole product mix? So I think those are the big issues that we need to know. The market needs to know, because they're behind the curve compared to the other mega stocks, mega tech stock, the Magnificent 7 or 6 that we are talking about. So I think these are trailing, but they always get the benefit of doubt. They have been getting for a long time, but at some point the patience is going to run out. Yes, there are a few things that they can pull. You don't bet against Apple when they are capable of doing a lot of things. They have the resources, they have the intelligence to do a lot of stuff, but they need to execute. They need to show the numbers. And at this point, we need to know China, AI, and the whole services. Why did that drop also? So I think we need to know that as well. So I think those are 3 areas I definitely want to know, because those are the anchors of this business.
And I assume you don't think that the Apple Vision Pro is the next catalyst.
I think it's too early. It's definitely useful. I didn't see the units yet. I think it's just getting started. It's starting selling, I think, this week. So it's really too early to say. I think the first wave is just going to be just priming the sales channels and everything. The next version is really going to be the real one, where you can see some uptake. The price tag is still pretty high. So I don't think you're going to see that, but definitely it's next product. They need to keep inventing, because their core signature product is stalling. So they need some more energy in the mix. And I think that'll be there. It'll take a while, though, a long time. It's very small. To move the needle, they'll have to sell a lot, and that's going to take some time.
You know, analysts say they've been, Apple's been kind of quiet when it comes to Gen AI, generative AI. Now, Apple doesn't, unlike some rivals, it doesn't, Tim Cook doesn't talk about what's in his pipeline. So perhaps they have something cooking. What do you think could be coming for AI for Apple? We've had some folks saying, listen, AI-enabled iPhones are on the way. Maybe it's this year, maybe it's next. But what's your take? What's your best guess?
Yeah, absolutely. They have to do it. I think 2025 is when we're really going to see those numbers in full swing, that technology incorporated in full swing. But I think in WWDC, we're going to get an idea as to how they're progressing, what is their strategy. They've already said that they want to incorporate that. They're investing. I think they put aside $1 billion investing in that category of trying to improve it. They have their own LLM. They're developing that. So I think they will come to the market with a good AI strategy. We just need to know. We need that to be very well articulated. At this point, we don't know that, but they're capable of doing it. The Siri can be upgraded, all their products can be upgraded. We can get that generative AI into all their product mix, just like Microsoft and Google have done. So I think a lot of capabilities, a lot of opportunities. They will get the benefit of doubt. So I will wait. So at this point, disappointing, yes, but I don't think it's a huge miss in the sense that the prospects ahead are still good.
Final question, so they missed on China. Obviously, Apple has put a lot of time and effort into India. How excited are you about that market? Both, by the way, as an end market for Apple, but also as a growing key link in its supply chain.
It's a huge thing. I think ex-China, India is the biggest market, and India is making every effort to make sure that they do a good job. And last I read, they're going to increase the production level there. So I think it has the manpower, it has the intelligence to take over from China. Of course, China is a very huge base. It's going to take a long time to replace that. But India is a good thing. And China has its own issues. There's nationalistic spirit. There's Huawei nipping at their heels. All that going on there. So India is a good takeaway from there. And they will benefit. Anything China loses, India benefits.
Santosh, thank you so much for that instant analysis here as we sift through all of these many numbers. Thanks so much. Appreciate it.
Thank you. Thanks for having me.
Well, still to come on Yahoo Finance, waves of layoffs rocking corporate America in the new year. We're talking the current state of the labor market ahead of Friday's big jobs day. Check out shares of Amur Sports. It's the parent company of brands including Wilson tennis rackets and Salomon skis. The company going public today. Pricing shares at $13 a piece. That was below the expected range. The stock is moving higher in its first day of trading. Also owns Arc'teryx. It was founded in Finland in 1950. But now it is owned by a Chinese-led consortium that bought it in 2019. One of the names who stood out to me, by the way, whose company is part of the consortium that bought it and took it public, Chip Wilson. He of Lululemon fame. So that was an interesting one. In any case, it's interesting to see that it priced lower, but now the shares are higher. They got the first day pop, perhaps, that the bankers were wanting.
Yeah, it is interesting too. It's obviously such a consumer-facing business, and why they decided to go public now is interesting too. Given there are still some uncertainties about the consumer, but big brands, Wilson, Salomon, Louisville Slugger.
Yeah, definitely. So it seems like there perhaps is demand here. If you look at the financials, it actually is not profitable. Net loss of $115.6 million in the first 9 months of last year on revenue of $3.05 billion. That was according to their IPO filing. So we'll see what ends up happening here. I mean, it is a big company, and we'll see if
Comments
they get
from the
profitable
CEO, by the way,
going
were kind of
forward. Yes,
interesting, telling reporters that he hopes he can double the share price from here, calls the price point frustrating, says it reflects a short-term view in his opinion. We'll see if he's right.
Interesting.
Yeah.
Do you have any of these products?
I don't. No, I don't have. No.
We do.
I mean, I don't ski, I don't play tennis, so.
Yeah, we definitely have some Wilson products in the household, as well as Salomon, which also sells hiking boots.
Maybe Dan Halley plays tennis or skis. We have him right here. We can ask.
I think Dan Halley only is in tech land right now. There's nothing else in the brain.
I just threw him. All
He's,
Dan has, and it's just AWS.
I thought I heard something about salmon. I have no idea. There it is. Okay. All right.
Dan is here to talk about tech earnings with us, not to talk about sports equipment. Happily, because he's been paying more attention to tech earnings.
Yeah.
So we have had a little bit of time to parse through these big 3 tech earnings that we have gotten today from Amazon, Meta, and Apple. What is our sort of big takeaway here as we look at them?
It's interesting, right? I think I said this earlier today about how you would see, well, I didn't say you would see, but we have seen in the past Alphabet miss on ad sales and Meta pass expectations on ad sales, and we've seen that exactly today. They're absolutely soaring right now. You can see up more than 14%, and part of that is because of the dividend that they announced, as well as the share buyback, that $50 billion. They did very well as far as overall ad sales, as well as daily active users on Facebook. So those are both huge takeaways for Meta. Apple, on the other hand, they reported better than expected earnings, but they're off more than 1%.
Yeah.
The reason? China. That's been a big question for them as far as iPhone sales. There's a twofold problem here. It's the sluggish Chinese economy, as well as a resurgent Huawei. The big deal there is that they're now back to producing phones after the U.S. basically cut them off at the knees. They're now getting chips. Where exactly is an open question still, I think. And they're putting those to use, and they're selling devices that can rival what some of the best on the market has to offer at a significantly lower price point. So that's hurting Apple there. We can look at overall sales. For China, they were expected to come in at $23.5 billion. They came in at $20.8 billion. But the reason why Apple managed to beat was on strong iPhone sales out of North America and Europe. So that helped them a lot. And then Amazon, I mean, just out of the park, they beat on overall sales. There was a slight miss, couple of $1 million on AWS. But just prior to the earnings announcement, they talked about a new generative AI experience for looking at new products on AWS. I'm going to throw this on Amazon itself. I'm going to throw this out there. They talked about how they kind of bring together some of the user reviews and generate a response for you on that. I used it independently because I saw it. Not a great experience. So hopefully this guy's a little bit better.
First, they got to fix the fake review problem, but that's
another, also
you
something.
know.
Yeah, every time I buy something, I get one of those things. Give us 5 stars, and we'll send you like, I don't know, a gift. And
right.
That's not really going to do it. I don't also need that on shoelace reviews. I don't know why I got that, but I got it. Wasn't amazing.
Were they fantastic shoelaces?
I threw them away. They were too long. It's so hard to buy shoelaces.
Apple will be great. That's a great roundup, Dan. Apple will be interesting because we get that guidance on the call. You know, it won't be they stopped giving formal guidance, but it will just be interesting on China and the outlook, puts and takes. Dan, thank you, sir. Thank you as always. Coming up, what to watch tomorrow, we break down the stories you need to know to start your day. Time now for What to Watch Friday, February 2nd. On the earnings front, big oil and healthcare are in focus. Exxon and Chevron announcing earnings in the morning. It's against the backdrop of sliding oil prices as the market monitors developments in the Middle East. Meanwhile, Regeneron, Bristol-Myers, and Cigna giving investors more insight into the healthcare space.
And it's a big day for the economy. The monthly jobs report for January is out ahead of the open. Economists expect 185,000 jobs were added to the economy. The unemployment rate predicted to tick higher to 3.8%. This follows the ADP report from Wednesday, showing private payroll growth coming in below expectations and declining sharply from December.
And finally, tune in for another episode of Yahoo Finance's Goodbye or Goodbye. Tomorrow, 3:30 p.m. Eastern, where we help navigate the best moves for your portfolio. Job cuts jumped more than 100% in January from the prior month. That's according to a new report out from Challenger Gray Christmas. Through a drastic jump, this year's cuts are lower than the same time last year. Joining us now is Andy Challenger, Challenger Gray Christmas Senior Vice President. Andy, it is good to see you. So I feel like, Andy, we almost get this kind of steady drumbeat at this point of corporate announcements of layoffs. Feels almost kind of daily at this point, Andy. Is that seasonality or no, something more serious?
You know, January is a month where we typically see a lot of layoffs in the economy. It's one of the times a year where there's a lot of turnover. Yet this splash of a wave of layoffs that happened this year really took us by surprise. The fourth quarter had gotten quieter and quieter. We were expecting this gently cooling labor market that we'd been watching for over a year, and to see it spike back up 136% in January from December was really a shock to us, and a sign that there really might be more turmoil to come in the labor market before this is all over.
Yeah, I mean, just today we got more news on layoffs from Zoom and Okta, I believe were the names today, announcing some job cuts. Andy, I thought it was interesting. You guys in your data looked at how many of these cuts could be attributed to AI because these companies are maybe putting resources elsewhere. So talk us through that number.
Yeah, we tracked a small number this month, about 381 jobs that were either cut because companies are moving to artificial intelligence instead of human workers for specific jobs, or they're closing departments to pivot their organization towards AI because it's a big potential for their organization. Over the course of the year, we tracked just over 4,000 job cuts up to this point directly attributed to AI. And I think that's probably an undercount. Most companies, when they're making layoff announcements, they're not trying to be newsworthy. They don't want to get a lot of headlines when they make these announcements. And anytime a company talks about artificial intelligence, you know it's going to be talked about for weeks, if not months.
So that's AI, Andy. What about the election? You think that's having an impact here at all?
Yeah, look, it's going to be a tumultuous year. There is a lot going on. There are world events. There are economic events. There are domestic political events with potentially a new administration coming in with different regulations. And so companies are going into cost-cutting mode. We've seen that throughout the year. We're expecting to at least see that through the first half of this year, where companies are bringing down their overall costs to anticipate and get ahead of any challenges that come throughout the year.
Andy, thanks so much for joining us on this very busy day. We got to leave it there. Thank you.
Thanks.
And that'll do it for today's Yahoo Finance Live. Guess what? There is that special jobs report coverage tomorrow morning. So join our colleagues at 8:30 for that. And then join us at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great night.